Hello everyone, I hope you are well and have been keeping safe and sound. The idea of today's video, just as well as the idea of setting up our own YouTube channel, is to try and explain complicated things in the field of financial crime compliance and tax compliance in a much easier language. So, let's start. The topic of today's video has actually been brought up by some of our clients who have been wondering whether a financial institution constitutes money laundering offense if it inadvertently transfers the proceeds of foreign tax evasion. Some clients have been arguing that there will be no money laundering offense simply because the financial institution didn't participate directly in the actual process of money laundering. Others have been insisting that there will be no money laundering offense just because this accident happened inadvertently. But to be honest with you, neither of this is correct. And in order to explain why, let's take a step back and get some refresh on the definition of money laundering. As you all know, money laundering is the process of turning money derived from criminal activity, so-called dirty money, into money which appears to have been legitimately acquired. So, pretty simple. Dirty cash or dirty money is turned into clean money. Traditionally, money laundering process has been defined as having three main stages: placement, layering, and integration. Placement is the stage where criminally derived cash introduced into the financial system. For example, Mr. A takes dirty cash, brings it to a bank, opens an account, and places this cash into his newly opened account. Layering. This is the process which involves a complex series of transactions designed to hide the ownership and the source of funds. Let's take an example with Mr. A. He just opened his new account. He goes to another bank, opens another account. Then he flies to a foreign jurisdiction. Let's assume it's an offshore haven with very low money laundering standards. He opens a couple of accounts there, and then he starts moving all his money in between those newly opened accounts. The whole idea of this stage of money laundering is to try and hide the audit trail and make it much more confusing for the local authorities to identify the origin of these criminally derived funds. And the last stage is integration. When placement and layering have been successful, the money turns out to be clean and legitimate. Again, let's take the example with our favorite Mr. A. He can fly to one of these foreign jurisdictions, go to a bank and ask them to give him his money. He is basically withdrawing cash, or rather than withdrawing cash, he can just transfer money for the purchase of a new car, or he can just do some online shopping, might be groceries or wristwatch, might be literally anything. The three-stage interpretation of money laundering comes from the time when money laundering was heavily associated with drugs-related crimes, where a large amount of cash was generated and needed to be cleaned. And because of this early definition, a very common misperception has grown up that money laundering can only take place when all three stages are present. But this is not right. At any stage, if a person is involved in the process, it will be sufficient enough to categorize the crime as money laundering. And all that is required from an individual is to start dealing with the proceeds of crime either directly or indirectly, or with their own proceeds or someone else's proceeds. Therefore, money laundering occurs whenever there is any form of arrangement involving proceeds of crime. In order to make things even easier to understand, let's take an example. Let's imagine there is an accountant who decides to steal from his employer $1 million. He does this successfully by manipulating balance sheets, and he splits $1 million into several tranches. One tranche goes to his personal account in a bank in offshore jurisdiction, another tranche is sent to his wife's account, and the remaining part is invested into a fund. The question is, have the accountant, his wife, the bank in offshore jurisdiction, and investment fund laundered the proceeds of crime? And the answer here is yes, they all have. Although individually they have not successfully laundered the money in a wider sense, they have all successfully contributed into the laundering process. And as such, they might all be at risk of being prosecuted for money laundering offense, depending on what can be proved on the subject of their knowledge or suspicion about the actual proceeds of crime or the crime itself. I hope this video was helpful for you. If you have any questions, please do leave your comments and don't forget to subscribe to our channel. Thank you for your attention. Goodbye.